So good afternoon. Thank you all for joining us for the first in a series of webinars hosted by Capital International on the Isle of Man. Pleased to see that we're joined by about 25 trustees at the moment, and I think we've had over 50 register, so hopefully a few more will join us as we go along. And we've got trustees from the Isle of Man, from Jersey, Guernsey, some friends from Switzerland and Monaco, as well as Gibraltar and Malta. So thank you all for joining with us this afternoon. So in this webinar, we're going to look at risk tolerance as a concept, and the purpose of the webinar is to share some insights and observations and really to provide some practical guidance for trustees with their investment decision making. And there are three main sections of content in the webinar. In section 1, we'll look at the current investment landscape across the major asset classes. And in section 2, we'll ask 4 questions about risk tolerance from a trustee's perspective. And in section 3, we will look at the differences between risk and volatility. And the session is interactive, and we invite guests to share questions. You can do that in the events chat feature, which you should see on the right-hand side of your screens. And we'll then cover some of those questions in a Q&A session towards the end. And we will also then debate what normal might look like from an investment perspective as we move out of the first phase of COVID-19. And we'll do that by inviting guests to join us in an open mic session at the end of the webinar, and you'll be able to access the open mic session. There should be a button on the left-hand side of your screen to do that. So to set the scene, really, let's have a look at the current investment landscape. And I think any trustee that's had exposure to major asset classes has just experienced the most volatile quarter, probably in their careers and maybe in living memory. And we're not going to debate the possible shape of a recovery in this webinar, whether that's a V or a U or an L or perhaps a W, or even the distinctions between a market recovery and a real economic recovery. If you'd like to see some of our content on that, then we'll be covering it in other webinars, and we have some articles, and you're welcome to visit our website to read our market updates. What we're going to focus on in this webinar is the analysis of some of the challenges that are facing trustees across all asset classes, and really look at how the risk and return dynamics have shifted during Q1 of 2020. And whether your objectives are income generation for beneficiaries or capital preservation for the long term or capital growth, each of the asset classes, in our view, should be considered in the context of this current investment landscape. So let's move on and recap briefly some of the moves that we've seen in equity markets, fixed income, commodities, alternatives, and cash. So if we look at equities, I think what's coming clear is that actually sector analysis is going to be key going forward. There's some fairly obvious sectors and spaces that are going to take longer to recover, aviation and entertainment, whereas other sectors and spaces, online retailers and technology, certainly in the short term, have benefited from the lockdowns. I think beyond that, stock-specific analysis is going to become more important, addressing and assessing the health of companies and identifying those survivors and the robust firms, and really getting back to basic fundamental analysis of PE ratios or return on invested capital. And I think we have to have an awareness of the risks of a financial crisis potentially arising from the health crisis that we've all lived through for the last 3 or 4 months. And I think some of the practical impacts are already being felt by trustees in client portfolios. I mean, if you take equity dividends that in the past have been a mainstay of some of the income generation in a trust portfolio, a lot of those dividends have been cut from financial institutions where the cuts have been forced upon them in order to receive the bailouts and the financial aid from governments, to the energy sector in particular, where if you take Shell as an example, they've cut their dividend by 2/3, and it's the first time they've done that since the end of the Second World War. And I think what else was remarkable that we saw, particularly in February and March, was the speed of the fall. It was dramatic. US markets have recovered approximately 2/3 from those troughs, but interestingly, not all stocks have recovered. And I think the speed of that recovery is predominantly to do with the massive stimulus package that we've seen in the US. Although in the short term, we have seen that the discussions around the return of the trade war are starting to be played out again. And I think one of the practical challenges that the trustees are faced with is the challenge of deploying capital into equity markets if you were harboring in cash coming into the crisis. And I think another very practical implication for trustees that were maybe invested in equities throughout Q1 is avoiding the temptation to increase risk exposure again to try and regain some of those losses. And there's a very simple rule that I think is worth bearing in mind, that if you've lost 20% in the value of an asset or a portfolio, then actually you have to gain 25% to get back to where you were. I think if you then look at fixed income as an asset class, it's clear that yields on US Treasuries and UK gilts are significantly lower, and we think they're likely to be lower for longer. If you look at yields on investment grade bonds, they've fallen significantly as well. And we've seen a lot of downgrades that have passed relatively unnoticed. The UK was downgraded. We've also seen in the high yield space the first few failures, and we expect to see more failures in the high yield space. So that hunting for yield has certainly become more risky. And I think one of the practical recommendations and considerations we'd look at is really get to know what exposure you have within your fixed income parts of portfolios as much as within your equity parts of portfolios, and get to know what exposure you have to sovereign debt, to investment grade debt, and to high yield debt. And I think one of the main legacies of COVID-19 in 3 months, 6 months, 12 months time is that there's going to be more debt, and that debt is at a government level, at a corporate level, and also at a household level. I think I had a quick check just of the US debt clock, which a few of you may go and visit occasionally. It started the year around about 23 trillion. It's now jumped up to 24.95 trillion. So we can already see a massive increase in global debt. And then if we move on to commodities, which I'm not going to dwell on here and we'll cover in more detail on future webinars, but it's clear that oil in particular has had extreme volatility during the start of 2020. And predominantly that's because of the demand side shock, which is unprecedented, and also the price war. And really one of the points we'd raise here is consider how you are exposed. Are you exposed through synthetics, through ETFs, and are those products leveraged? And also considering sort of how long will it take for demand to recover? I think if you look at gold, it was very interesting through Q1 that we all kind of brought up to expect that gold will act as a hedge to equity risk. And actually what we saw very early on in the crisis is that gold sold off as much as any other asset class as investors raced to raise liquidity across portfolios. We did later see towards the end of March and into April that gold started to behave a little bit more like the traditional hedge that we're used to seeing. And then just finally in commodities, I think within agriculture, which hasn't really had much coverage, there is the potential for a supply side shock, particularly in emerging markets, and that might be caused by supply chain disruption, closed borders, or something like swine flu. But I'm not going to cover any more on commodities now, and if you're interested in that area, please talk to us later. I think the other major asset class, and probably where we've seen the most fundamental paradigm shifts, is cash as an asset class. Interest rates have been cut dramatically across all major currencies, and rates are now either near zero, at zero, or negative. And harboring in cash, which through prudence or caution many trustees may have done to protect capital in Q1, whilst that has certainly provided that protection, I think the challenge now is for trustees to try and find where to where to hold deposits. And whilst that's been a challenge for clients holding euros for the last 2 or 3 years, it's now just as much of a challenge for sterling and for dollars. And I think liquidity has been raised again as just how important that is within portfolios, and having that dry powder ready to allocate and have the flexibility to take advantage of buying opportunities. And I think for many trustees that maybe did have an overweight cash position coming into this, they may have the willingness and the desire to start entering into risk assets again. But the challenge there lies in how do you deploy capital? And I think one of the sort of practical experiences we've had in Q1 is helping trustees with those challenges and trying to help them to drip feed into the market and the old rule of sort of dollar cost averaging in to the market, rather than trying to time. And as anyone who's been an investment manager or been invested in markets for any length of time knows that trying to time markets is a fool's errand. So I think that just highlights a little bit for major asset classes and how returns have shifted, and actually risk profiles are really being tested. And we'll now start to have a look at the dynamics for a typical moderate risk mandate, which many of you probably have numerous moderate or balanced investment portfolios. And some of those may have seen losses of 10 to 15% on a discretionary portfolio. And I think there is a temptation to try and recover that lost ground by deploying more capital into equity markets. However, this could fundamentally shift the dynamics of a balanced portfolio, and it might be outside of the confines of a trust's investment policy statement. Trustees might also be drawn to more esoteric investments that promise uncorrelated returns. And I think, as we saw in 2008, 2009, as we came out of the global financial crisis, that invariably such strategies are not marked to market and they're illiquid. So a little word of caution there on searching for uncorrelated returns. And I think a broader message really is that it will take time to rebuild value in portfolios, and that Rome cannot be rebuilt in a day. So as risk profiles have been tested, and I think the immediate challenge faced by trustees as they sit down and perhaps review their Q1 statements, once they've assessed the damage, is to consider whether the pre-COVID-19 investment strategy will be suitable and effective in meeting the investment objectives of the trust going forward. And actually this made us think about our investment requirements and our risk profile questionnaires that we ask trustees to complete when we're appointed to a mandate. And in normal times, this process and completing that form is very much an academic process, and many trustees will sort of tick box and mark 5 for everything and then move on and not really think much more about it. But in very volatile market conditions, those questions really come alive and provide a true test of an investor's appetite for and tolerance of risk. So we're now moving into the second section, and very much an interactive section, where we're going to cover 4 questions, and I invite you all to rescore along the way. Perhaps think of a client case that you're working on, or that is typically a balanced portfolio, and the scores will be on a scale of 1 to 10, or the relevant time period. So the first question is: all investments involve risk. What level of short-term loss are you willing to accept in pursuit of long-term investment returns? And I'll just repeat that question. So all investments involve risk. What level of short-term loss are you willing to accept in pursuit of long-term investment returns? And the range there is very low, less than 5%, all the way up to very high, greater than 35%. So just have a quick think about that and see where you sit on that score. 1 for very low, less than 5%, up to 10 for very high, greater than 35%. So as we move to question 2, the second question is: how long are you prepared to hold investments after a fall in markets to enable them to recover? So that's how long are you prepared to hold on to your investments after a fall in markets to enable it to recover. And the option there is a time range with 6 months being the shortest time period, out to 10 years plus for the longest time period. So again, just have a think of that and sort of mark where you would see a typical balanced portfolio sitting on that scale. The third question, and I think this is where it really gets interesting, the third question is, how would you respond to a sudden fall in markets? For example, a 15% fall in 6 months. Now, as we saw in Q1, we actually saw a 35% fall in some markets in the space of 2 weeks. So actually that sudden fall, I think we could say, was a very sudden fall in markets. And the answer to that question, the option is sell all or buy more, with sell all being a 1 and buy more being a 10. So I'll just repeat that question. How would you respond to a sudden fall in markets? Would you sell all or would you buy more? Or do you sit somewhere in the middle? The fourth and final question is a very general question which often gets ignored, but actually I think it's in the light of experiences over the past few weeks and months, I think it's quite pertinent. And the question is, how comfortable are you making investments? And the option there is very anxious, which would score a 1, all the way up to very comfortable, which would score a 10. So hopefully you've completed those 4 questions. Keep hold of your scores, and we'll cover those when we come to the Q&A and the open mic session later. I think going through that process just highlights a little bit that it's never been more important for trustees, directors, fiduciary professionals to assess and consider the suitability and the appropriateness of the investments that are held within structures under their care. And whilst we've seen a trend for benchmarkers and gatekeepers, and they certainly serve a very valuable purpose, actually the ultimate responsibility to beneficiaries rests, as it always has done, with the trustee. And I think there are a few considerations which we'll go into in more detail later, but just one to raise. I think it raises the issues again of the risk of execution only clients, where perhaps a beneficial owner making a case against their own past investment decisions. I think we saw that in the global financial crisis, and also the potential for future beneficiaries to actually look at what care and appropriateness there was around previous investment decisions. And I think a very practical point that actually those indemnity clauses that you may well have within trusts, they don't offer that much protection if clients become litigious in the future. I think the next area that we'll look at, and this really is section 2, is looking at the difference between risk and volatility. And just to set the scene here, I'll quote one of my favorite authors, and probably someone you may have followed, Nassim Nicholas Taleb. And the quote that I'm going to share is, "Not seeing a tsunami or an economic event coming is excusable, but building something fragile to them is not." So I'll just repeat that so it sinks in a little bit, and it's kind of in context with where we are now. So not seeing a tsunami or an economic event coming is excusable. However, building something fragile to them is not. And then the second quote is from probably the most famous and most successful investor of modern times, Warren Buffett. And interestingly, he says that volatility is not the same thing as risk, and investors who think it is will cost themselves money. So let's try and unpack that a little bit. And I think maybe some definitions around risk and volatility would be useful. There's certainly concepts that as investment managers we deal with day to day, but we've come from a period of 10 years really where maybe trustees haven't seen or felt any volatility in portfolios. Volatility has been very low. So let's just look at those 2 definitions now. And we'll start with risk. So risk at its most basic level in financial terms is defined as the uncertainty associated with any investment, and that the actual returns will differ from an expected return. So maybe an example of an expected return of 8%, but the actual return is -4%. I think that's an example there of the uncertainty associated with an investment, and that the actual return will differ from an expected return. Whereas volatility, defined in financial terms, is best described as a statistical measure of the dispersion of returns for a given security or market. And volatility can be measured using standard deviation or variance between returns from that same security or market. And if we look at volatility, volatility is objective, it's quantifiable. Whereas if we look at risk, it's very much subjective and also requires a lot of qualitative analysis. Volatility is backwards looking, whereas risk is very much forwards looking and looking to the future and assessing risk. Volatility, and I think this is probably one of my favorite points, and if there's one you remember from the session, it's this, that volatility is the same for absolutely all market participants in a given market, whereas risk depends on a client's circumstances and their financial landscape and their investment horizon. So anyone who's invested in the S&P 500, they're all subjected to exactly the same volatility in that market. But actually the risk associated very much depends on the client's circumstances, their financial landscape, and their investment horizon. And I think one of the most commonly held false assumptions in portfolio management is that you must take higher risks to generate higher returns. I think more accurately, if you want higher returns, higher volatility is mandatory, higher risk might not be. So let's look at one of the measures of volatility. And you probably have heard this a lot in the Financial Times and in the headlines of late. So we hear a lot about the VIX. What is the VIX? Well, the VIX is intended to provide an instantaneous measure of how much the market thinks the S&P index will fluctuate in the 30 days from the time of each tick of the VIX index. Now, it's measured every 15 seconds, so it can move incredibly quickly, and it's often referred to as the fear gauge, and it quantifies current investor sentiment. Now, before logging into the webinar, I had a quick check to see where the VIX was, and it's actually dropped off in the last couple of days. Yesterday, it was at 40. Today, it's at 34. And at the height of the crisis, it broke through 80 and 85, and its highest end-of-day average was 65. Now, interestingly, pre-crisis, coming into 2020, the VIX had been at or around 12 for an extended period of time. Some of you might remember that we had a flash spike of volatility back in February of 2018, where it spiked through 50, and again in October and December of that year. But in general, we've had 10 years where volatility has been very low, and Q1 of 2020 is the first time that we've seen some sustained volatility in markets. So what do we make of that? Well, on that basis, investors are currently less fearful about markets than they were at the height of the crisis in February and March, but they are still significantly more fearful than they were at the end of 2019 coming into this year. It's also interesting to consider some other investment terms, and beta would be one, where beta, which is the security, the measure of the volatility of a security in relation to a market, and also correlations. And I think in Q1, assets that we would usually think of as having a low correlation all moved together. And I think that comes back to the point of being aware of the promise of uncorrelated returns, that these assets are invariably illiquid and not marked to markets. Now, we're not going to dwell on these concepts. We'll unpack these measures in more depth and detail later in the webinar series. I think some of the broader intellectual concepts that we've started to hear about again are some that you may remember from the financial crisis. And we'll just recap and draw attention to some distinctions here that make COVID-19 and the market conditions very different in nature and severity to the global financial crisis. And the main concept there, and again coming back to Taleb, would be the concept of the black swan. And just to define what Taleb means by a black swan, and the definition is, beyond normal expectations, It's an event that is so rare that even the possibility that it might occur is unknown. And when it does occur, it has a catastrophic impact. And another trait of a black swan event is that it's explained in hindsight as if it were predictable. Now, right back in January, I remember sitting in a meeting with a client and they asked, well, do you think COVID-19 is a black swan event? And this was right at the point where we had some knowledge of it coming out of Wuhan, but the lockdowns were still many weeks away. And I thought about it and I said, well, no, I don't think it is a black swan event because we do know where it's coming from. And actually, if we come back to Taleb, it's interesting in the last couple of weeks, he's defined COVID-19 as a white swan event. And the distinction here is that a white swan event is a predictable financial crisis that happens not spontaneously, but naturally. And I think that's can be summed up that actually governments weren't willing to spend pennies in January, and actually now they're having to spend trillions. So that's just a little look at some of the terminology and some of the concepts. It's now time to summarize some of the key takeaway points and to move towards the Q&A section. So I think in summary, trustees should endeavor to ensure that the assets and strategies stay aligned with a trust investment policy statement, and that actually the eagerness to maybe recover lost ground or the search for yield can lead to decisions that shift the dynamics of a trust portfolio away from the long-term investment objectives, as can being overly cautious in the medium term. I think understanding the difference between risk and volatility, it's a subtle but important distinction. And I think take risk profile questions seriously. Think how decisions about asset allocations and weightings impact long-term returns. And I think most importantly, understand what you are invested in. Review those assets, think about your exposure, and review those assets again. Now, we can help with quantitative and qualitative analysis, and we actually enjoy doing that work. So please do ask questions in that area or talk to us afterwards. I think another point worth noting and real experience here is we're seeing a trend towards asset-specific mandates at a higher level. So perhaps for clients with 20 million plus, that maybe it warrants having a equity-only mandate, a fixed income-only mandate, a cash strategy, and maybe a commodity strategy. And I think ultimately your fiduciary responsibility is to preserve and grow capital, and that any strategy that may contain a potential ruin should be avoided. As David Long, our Chief Investment Officer, noted recently in conversation, that you can't let a recent white swan event overly impact your investment decision making, and that actually it's your investment horizon and your long-term objectives that should ultimately guide investors to a suitable and an appropriate level of risk within an investment strategy. So on that note, we'll now cover some questions and provide some answers, and we'll then also move across to the sessions feature, which I hope a few of you will join us for, which will very much be informal and will provide an opportunity for you to have direct access to David Long, also Anthony Kelsey, our Commercial Director, and members of our wider investment team. And I'm sure some of you will be missing the trustee conferences, and really what we want to do in the session is have that more informal debate about what might be normal coming out of COVID-19. If you are logging off now, I'd like to thank you for joining us, and we hope to see you again in the next in the series of webinars, which we'll be hosting in about 6 weeks' time. So moving into the questions and answers section, certainly thank you everyone for noting down some of your responses to those questions. And I think some of those responses, perhaps knowing some of you that have put those responses, maybe they are a little bit skewed and biased now to being slightly more cautious. I know that there's one question from Anthony Kelsey, our Commercial Director, and I think it's a very interesting one, looking at perhaps trustees that have clients in emerging markets. And something we didn't cover in the earlier content is that actually a lot of emerging market currencies, let's take South African rand for example, might have lost 10, 15, 20% in value during the course of Q1. And now that does create a dilemma for a trustee, where they may have a client who is in cash, has seen the value of that cash depreciate, but on the other hand also has a desire to take advantage of buying opportunities in equity markets. Now, I think the approach there, and we've covered some elements of it, is actually maybe looking at dollar cost averaging, and you might not be able to pick a rate that you're happy with or the client is happy with, but actually if you break it up into tranches, you're likely to get a better average rate. I think also very practically, and we have an experienced team of professionals in South Africa. So if you do have South African or African clients with exposure to the rands, then please do come and talk to us about those strategies. I think equally, if you have clients in Latin America, we've seen the impact in Brazil and the Brazilian real that has really suffered through the crisis. And what we've also seen is the Bovespa in Brazil is at one point was down about 50%. So I think clients there with their exposure in their home domestic markets, and the challenge of trying to get them to that point where they have more of a balance between their domestic assets and holdings and their international portfolios. These are the sorts of challenges that trustees are faced with, and that we'd be very pleased to try and assist you with. I haven't seen any other questions come along in the events channel, but thank you for those. Thank you, Jason and Nick, for your questions there, and David and Andy. So I think we will now try and move across to the sessions area, where I'd like to just ask a question of David to start with, and really relating to investment horizons and how important the investment horizon is when you're looking at your ability to tolerate volatility in the short term. And just wondered if you could perhaps share a few comments of your experience of that, and actually your experience of being an investment manager in Q1 of this year.
Yeah, of course. Well, Q1 of this year was an extreme event, wasn't it? Once in pretty much 100-year event. And so it's not the normal scenario. The question was around time horizon and the importance of time horizon. And time horizon is critical when setting a risk objective for a client. And the reason for that is really that in order to set the correct strategy and risk objective for a client, one has to balance two things. The first thing is the risk of loss and the risk of short-term loss. And the second thing is the risk of missing out on long-term gain. And so those two things need to balance off. And the crucial factor in determining how to set the balance between short-term loss and long-term gains is your time horizon. In other words, the longer that you can be invested for without risking being thrown out or shaken out of the market, the longer term view you can take, and the more important it is that you have exposure to long-term returns as opposed to worrying about short-term volatility. And despite the magnitude of what we've witnessed in March and in the first quarter of this year, and let's make no mistake, this is an extreme event where we saw effectively some what you call safe haven asset classes effectively cease to function effectively because of liquidity runs. So an extreme event, and yet this particular event from a market perspective will most likely be fairly much in the past and forgotten within 18 months to 3 years, something of that sort. So if you're a 10-year investor, if you're saving for your retirement, for example, perhaps you've got 25 years to run, the short-term volatility that we've experienced in this 3-month period is irrelevant. All it actually does is it gives you an opportunity to invest at a lower level. And what is really relevant to you is the compounding effect of getting an extra 1% or an extra 2% in your long-term investment return over 25 years. and the compounding effect of that is absolutely enormous. So that's where one has to set the balance, and time horizon and being very honest about your time horizon is critical. Clearly, if you need to access monies within 1 year or within 6 months, risk takes on a whole different characteristic from a 20-25 year investor.
No, thank you, David. And it'd just be interesting to hear if we've got a brave trustee out there who's willing to ask us a question from the floor, or just to share a bit of experience in terms of feeling what it was like as a trustee in Q1. I think as a whole, we've seen a lot of institutional investors actually quite keen to enter the market, but really not quite knowing when or how to do so. And I think that is one of the challenges. And actually, we've seen this recovery, which has been very rapid in the last couple of weeks. And I suppose it comes back to the looking at the longer term rather than having the focus on the very short term noise and activity in markets. So who else have we got around there? I can see we've still got 33 on the webinar itself, and I think we've got 16 watching here. So if you don't want to chat, then you're very welcome to put comments in the chat section, and we'll be able to pick up questions there for you. Whilst we're doing that, we'll maybe just turn to Anthony Kelsey and sort of your experience, Anthony, from a South African viewpoint, really. How has our South African office experienced the Q1 of 2020 and the, I suppose, the impact from a RAND perspective?
I think it's an interesting one, and actually, to some degree, South Africa hasn't been wildly different from the rest of the world. I think this scenario was so quick in its coming and was so impossible to react to, and it happened so quickly that I think all clients were almost as we've just got to sit tight and sit this out. As always, there's been a couple of clients who, unfortunately, as much as you try to persuade them that perhaps they do need to sit it out, they're too nervous and they do come out, and then they've missed some of this quite steep upside over the last couple of weeks, which is a shame. But every cycle like this, some of the retail clients just find it too much of a roller coaster for them. I think from a South African perspective, clients are more realistic, and if they're already offshore, they're certainly not going to start moving monies back to South Africa. The big question now is, at what point do clients decide to externalize further assets? A lot of them are very jittery. South Africa's had a downgrade, and some clients just bite the bullet and say, we want to increase our exposure offshore, we want more of an emergency fund offshore. Not that it's easy to flee the country, obviously, now in lockdown, but if that scenario comes to bear, they want that ability to know that they've got sufficient assets offshore, and so they'll just take that currency hit. The question then, of course, is, well, what do you do with the assets once you've moved them offshore? For others, it's a case of, well, I'm not bringing my RAND out at 20 plus to the pound or whatever it is right now, but at what price level do they then decide to make the decision to jump? So it's tricky, and I don't think we've got any trends yet. It's just about keeping dialogue going with clients out there.
And I see we've got Richard Johnson from our South Africa team on the call as well. And Richard, have you got any sort of insights on the ground?
Sorry, Greg, you're breaking up. Have I got any insight into?
Any feeling about where the RAND is, that balance between the to their international?
So I personally wouldn't go out on a limb to call the currency, but the irony of it all is that we deal with one of the FX companies, and they were saying that even with the rand at these levels, people are still continuing to send as much as they can in fear of it further worsening. But then the irony is that when the rand pulls back, they won't send money because they think it's on a sort of positive stretch, and that the rand will further strengthen. So I think to add to what Anthony is saying, from an externalizing perspective, with the currency being as weak as it is currently, people are still certainly doing it.
Yeah, and I think it'd be interesting just to get some perspectives on different jurisdictions and the experience of different jurisdictions. I know we had some guests attending from Switzerland and from Monaco and Malta and Gibraltar, and it'd be interesting just to hear sort of how your responses have been, whether you've seen it differ for clients that maybe are second or third generation long-term clients already in dollars or euros or sterling, versus maybe your more entrepreneurial clients that are in emerging markets. So I don't know whether we have anyone that's in Geneva or Monaco still on the call. And if you do have a question and want to chip in, you're very welcome. If not, I think we will probably wrap up some of the questions. I can see 17, 16 of us are on the call. I don't know whether anyone's had any issue trying to ask a question. If you have, then please do get in contact with us afterwards, and we'll make sure we cover those questions in our next webinar and the next Q&A. We do have a session tab. Very good. We have got another question. So I'll ask the question as it's been posed. Are you preparing for another big dip in the markets should the lack of a vaccine result in long-term impact on business opening up again globally? So I think we'll sort of turn to David probably for that and addressing it. I think one thing we have done, and we've looked at different the risks of that second wave and what shape a recovery might take. And yes, certainly we're very much aware of that risk. But if we could just turn to David to answer that question and how we look at it on a daily basis, I suppose.
Great, thank you. So the question, if I'm reading it right, is are we expecting another big dip or are we preparing for it? The answer to that is it certainly would not surprise me if we saw another substantial fall in markets. It's quite possible we could test the lows that were seen towards the end of March. I'm currently doubtful that we will go below those lows. Although there is still the possibility of a financial crisis to follow the health crisis. I think it's unlikely, just simply because central banks are not going to allow that to happen, and they have made it clear they will do whatever it takes to prevent it. Are we preparing for another big dip? Well, I'm not at the moment looking to take advantage of a fall in markets by selling and buying back. I think that's a bit of a fool's game at this point in time. And although another fall in markets is entirely possible, I think it's more likely that we will see a steady improvement in markets over quite a long period of time. And therefore, if we do see the fall, then we will be taking advantage of that by buying into another fall in markets. I believe that the values that you could buy assets for on the 24th of March are probably values that we're not going to see again for 10, 15 years, perhaps longer. And therefore, they were really lifetime opportunities to buy the market, not the other way around. One of the reasons why I think that markets are likely to continue to improve gradually is because essentially the ground has been shifted beneath our feet through monetary policy. So I'm not saying that suddenly the economy is going to be straight back to normal and that the value in shares is going to get back to normal. anytime soon. What I'm really saying is that the value of the market today, or the price of the market today, has been artificially manipulated by the monetary policy. So, for example, let's say the S&P 500 reached a peak of about 3,300 towards the end of last year. Well, the effect of monetary policy is to give the equivalent value today somewhere up near 3,800. And therefore markets have recovered somewhat, but the 3/4 that we see in price terms does not reflect the true value recovery that we've seen, because the whole ground has been shifted by the monetary policy action. And therefore, I think the likelihood that we're going to see new lows is, well, probably 25% or lower than that. And if we see anything like the levels that we saw on the 24th of March, we would be buying into markets, not selling.
Thank you, David. And I see we've got KB Initials that has been brave enough to come on to the open mic section. So just invite you, if you've got a question, if you'd like to share it, or whether it's just a thought on your experience during Q1. We've left an opportunity there for you to ask a question, so let's just have a look and see. Perhaps it's been raised in the chat section. So thank you. So the question, and I'll raise it. So see, we've still got most people on the call. So the question is, what changes have you made within portfolio models to weather you through this period of volatility? So I think then I'd probably turn to David to answer part of that. But I think what we have seen very much is, as we talked about in the content really, is looking at sectors and looking at themes. And there are, and maybe there is a point now where perhaps if you have, if you try to have very general exposure through going and buying an ETF of US equities, you're still going to get exposure to aviation, you're still going to get exposure to entertainment and travel, whereas actually being more precise about your exposure within sectors and being more selective and more analysis of those sectors and also the underlying assets, I think that becomes increasingly important. So, and I'll turn to David now, because we do have our regular discussions about our portfolio models, and that's sort of steered by David in many ways.
Thanks, Greg, and thanks for the question. It's a really interesting question, because in essence, the crisis hit so rapidly that there's very little that one could do sensibly in terms of reducing risk in any way to protect portfolios. So a lot of this was determined in advance of the actual crisis occurring. So our portfolios were actually reasonably cautiously positioned, but we were by no means expecting or anticipating anything like the severity of the crisis that has materialized. As soon as we started to see 5%, then 10% falls in a day, you're really out of the bounds of being able to trade a market in any kind of a sensible fashion. And therefore, our focus turned to, well, hang on a minute, let's look for the stocks and the assets that we want to hold long term, and let's find great prices to buy these assets. So the work that we actually did in portfolios over that time was twofold. Firstly, we had to raise some money from more defensive assets so that we had some cash to deploy into equities. And we raised a little bit of money from gold quite early on, and we raised a little bit of money from bonds quite early on as well, and some of our alternative strategies as well we raised some money from. And we raised that money with the intent of adding to risk as the market, as the crisis reached its peak. And we did that reasonably successfully on an individual stock basis and in a few different places. we still have around 10% or so of cash in our portfolios. And as I said a moment ago, if we do see markets pull back anything like a material pullback, then we will be adding to risk within the portfolios and not reducing it.
I think as well it has made us think and re-look at asset allocation models in general. And I think over the last 10 years, there had been a trend towards sort of fixed income proxy assets. So having some of the low volatility funds in there, maybe some of the absolute return strategies, having sort of property REITs within portfolios, to try and replicate what fixed income used to do. And actually, I think what was very clear during Q1 is actually those assets didn't really do what we anticipated they would. So I think there has been some questioning and analysis of those sorts of funds that purport to provide lower volatility of returns in volatile market conditions, or downside protection, and just questioning the value of them. And perhaps we will see a bit of a return to more of a balance between equity risk and fixed income assets and then the commodity space. I think that will depend very much on client circumstances and the type of model, but it's certainly an area that I think managers will be revisiting and looking at and sort of assessing, do they add anything to the portfolio apart from sort of a bit of illiquidity, and also I think the element that was very noticeable, that there were good assets being sold off because of the hunt in the market for liquidity. I hope that answers some of your questions, KB, and thank you for asking the questions. So just invite if there is anyone else there that would like to ask a question, or had any comments on any areas of the content that we've covered today. And hopefully the technology will work for you. Our plan is to do a series of these webinars and really do a bit more depth and detail. And thank you, KB. I just see the response there from you. So I'll just read the response in case other participants can't see it. So it's just saying, thank you. Nothing you've said that we don't expect to hit lows. Noting you've said that we don't expect to hit the lows of March. Do you think this is a bear market rally? Okay, so I'll throw that one straight over to David and see, do we think this is a bear market rally? I'll hear David's comments first, and then I can see Anthony chuckling away there as well. So we'll turn to Anthony. You can't chuckle and not get asked a question, Anthony.
We have lots of different views, so I'm sure Greg will probably to say, because he's a bit more bearish than I am. The answer to that, from my perspective, is I don't think we're in a bear market. I mean, it's almost a point of definition, in that typically a bear market takes a period of time where essentially excess credit and excess debt starts to unwind and leverage starts to unwind, until such a point as investors get dragged back into a market, and that process usually takes 18 months, perhaps 2 years, perhaps even 3 years in extreme cases. What we've seen so far is somewhat different in that it is an absolute shock to the system, and it's happened hard and fast. The closest analogy is 1987. Where we saw whatever it was, nearly a 30% fall in 2 days in equity markets, and subsequent to that, a long, steady, protracted recovery. So a bear market rally would usually indicate that we're in a negative trend that's going to last for 18 months, 2 years or so, or that's the broad trend. And what we're seeing in the short term is just a rally within that negative trend. I don't think that's necessarily the case. I think we will probably move sideways for quite a long time, but the big shock to the system has already occurred. So the real question determining whether we're going to be in a bear market from here on is whether economies are going to get back to any semblance of normality within a reasonable time frame. or whether this becomes a self-reinforcing spiral that takes us lower. I think it's the former and not the latter, but Greg's going to tell me the opposite. Go on, Greg.
Well, I think this is a good example of where, as an investment committee, we have this debate every single day, and it's great to sort of share some of our views. And yes, you need a combination of sort of realist bulls and bears, and I've always tended towards the bearish end of the spectrum, in spite of being in the role that I'm in. And I think there is a potential risk that actually where we are is far more like 1929, but it's also a combination of 1929 and 1918, both colliding at the same time. I think what is different is we're 100 years on from that, and we have technology. We have a far more connected world where we've got more tools and ability, and the race to find a vaccine that should shorten the impact of the virus itself. But there's no doubt that the 30 million plus unemployment in the US, the drop in consumption globally, and the increase in debts from a household, corporate, and sovereign level is going to lengthen the time of an economic recovery. And that was one of the distinctions, I think, that we maybe will go into in more detail on a future webinar, is this V shape that we've seen in equity market recovery. It's almost as rapid as the falls were in February and March. And I know a lot of trustees in particular just don't trust that recovery. So I think we are seeing a separation of market recovery and maybe what a bear market rally looks like in equity markets, and then what the global economic picture is, and how long it takes those unemployed to get back into work and really to start spending again. So I think we'll see that over the next 3, 6, 12 months. I think there is a second wave risk in October and November, but let's try and be positive and hope that the vaccine is discovered, and that it's deployed, and that the global economy recovers rapidly. I think the other element, and again, we won't discuss it here in any detail at all, but the last couple of days we've really seen the trade war tensions ratchet up another notch, and I think now we're starting to see the discussion shift from directly from COVID-19 to actually the mudslinging between the superpowers of this world, and I think the next 6 months pre-US election we're going to see increased sort of volatility in that area. So hopefully that kind of a few insights there help. Anthony, anything you want to add to that?
I think the reason I was smirking was I was thinking, how on earth do you answer that question? But I think from my point of view, it's interesting hearing both your and David's views. The bit that I struggle with is we always look for something in the past to compare to. And I think in many ways, this isn't like anything else, whether that's because things were ages ago and we're in a different, world altogether now, and things happen far more quickly. But even if you look at the way different countries are reacting, on the way into the lockdown, through the lockdown, and on the way out, there's no consensus. And I think for me, and I'm not a day-to-day investment expert, as you know, it's the unpredictability of it, and that's the bit that I think is difficult. And I think it's going to be some time before there's any real trends to see, which is the right way, and that's the bit that is so unsettling. But yeah, that's my thoughts.
I think one thing we certainly are doing, and we've talked about it on our investment calls a great deal, is actually we do need to have a closer look at the health of financial institutions, and just to see how impacted they may or may not have been, particularly European financial institutions, and maybe less so in the US. And maybe it's that moment where there's been a pebble or two dropped in the ocean, and we'll start seeing those ripples out. And I think if Taleb was on the call, he'd probably say something like those tail risks are there and maybe greater than they were prior to the white swan event that we've just experienced. So, but that's the nature of black swans. You don't know where they're going to come from and when they're going to appear. I think David's point he made a week or so ago was that there is this bias that, and particularly bearish viewers, that if you've just had an event, you tend to become more cautious. And I think Nick, who was on the call earlier, might still be there. Normally someone I'd think of as being quite bullish, and your response was a 2. So I think it's kind of an awareness, actually, as a trustee, perhaps not letting what's just happened overly impact you in terms of becoming overly defensive or overly aggressive in trying to recover those returns. But to certainly review.
I'd make one comment, Greg, if you don't mind, which is that I think it's a mistake to view the market as a whole and trying to answer the question as a whole for the market. The reality is that the outlook is totally different for different industries and for different companies. And I think you illustrated earlier on about the airline industry, which may take many years to recover. I'm sure it will recover, but it may take a long time. And that's only the obvious sort of areas. There are far less obvious areas that stand to benefit. For example, I mean, the tech sector has done fabulously well, and up until a couple of days ago, Amazon was an all-time high, and there will be sectors within the economy that just go from strength to strength, and there will be sectors that perform abysmally over the next period of time. And therefore, I think one has to be very careful about both the sectors and the individual companies that one is selecting in order to answer really the question about whether we're in a bear market or a bull market.
Yeah, and I think there was quite an interesting article recently in the FT where it highlighted that maybe there is going to be a lopsided recovery, that there will certainly be companies that the large cap companies in the right space that are going to weather the storm very well, but maybe in the small cap space in the retail sector or travel area or that area, they're really going to suffer. And actually that might be felt just as much in the high yield bond space as in the equity space. And I think that's an area that gets little attention really in terms of reviewing assets, but probably more important now than ever to review your actual exposure to different bits of the bond market.